Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Cenovus Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Cenovus Energy is an integrated oil and natural gas company headquartered in Calgary, Alberta. It was formed in 2009 when Encana split into two distinct entities, with Cenovus becoming focused on oil sand assets. In 2017, Cenovus purchased ConocoPhillips' 50% share of their Foster Creek, Christina Lake oil sand projects and most of their conventional assets in Alberta and British Columbia, including the Deep Basin. Cenovus also completed the acquisition of Husky Energy for $3.9 billion Canadian dollars worth of stock in January 2021. This company trades on the NASDAQ under the ticker CVE, but we're going to look at the ticker that trades on the Toronto Stock Exchange, since the company reports its financials in Canadian dollars. Let's get started with the model. This is a large cap company, 16 billion market cap. They're trading at $7.55 a share and they have 2 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see the company has positive free cash flow each year, peaking in 2019 at $2 billion, but they did have a negative in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they do have positive net income in 2017 and 19, negative in 2018 and the trailing 12 months. Revenue is a sales for the company, and that grew quite a bit from 2017 to 2018, then dropped a lot in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales, and then below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then below that is gross profit, which is the difference between revenue and cost of revenue. And their gross profit was the lowest in the trailing 12 months at $6.5 billion due to low revenue from COVID and low oil prices. Below gross profit is operating expenses, and below that is operating income. So the company did have negative operating income in the trailing 12 months and 2018. They have about $500 million of interest on their debt. Then below that is other income and expenses. And this is usually impairments if it's negative. And they had negative $1 billion in the trailing 12 months, negative $2 billion in 2018. The reason they had such big negative net income was not just because they had negative operating income, was because of these large negatives in other income and expenses. So you can see their net income is pretty volatile. 3 billion positive, negative 2 billion, 2 billion positive, then negative 1.7 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. And this company has between 1 and 1.7 billion of CapEx each year. Operating cash flow minus CapEx gives you your free cash flow. And free cash flow is the cash that's remaining to grow your business, to pay down debt, to pay a dividend, or to buy back stock. And this company did have positive free cash flow every year except in the trailing 12 months. In 2017, the company issued $7.5 billion of debt and paid down $3.5 billion. So they added $4 billion of debt that year. In 2018, they paid down a little over $1 billion of debt. Then in 2019, they paid down about $2 billion of debt. In the trailing 12 months, they issued about $500 million more of debt than they paid down. They also issued $3 billion of capital stock in 2017. If a company's generating free cash flow and they're issuing capital stock and debt, it probably means they're trying to acquire another business. Some companies do issue debt to pay dividends if they don't have enough free cash flow. The most important part of any business is their operating cash flow. If you cannot generate positive, consistent operating cash flow, you don't have much of a business. This company does generate a lot of operating cash flow, about $2 to $3 billion a year, except in 2020, which was a strange year, but they still managed to generate about $900 million. And the way you calculate operating cash flow, you start with net income, that was negative 1.7 billion. Then you have to add back the depreciation. That's a non-cash item that gets passed through as an expense onto the income statement. So when you invest in a company or value a company, you should look at operating cash flow. That's a better indicator of a company's health than net income. Net income is their accounting profit and loss. It's not actual cash. Cash is king. That's what you need to run a business, is cash. And that's what operating cash flow shows you. In 2017, they reported a $3 billion loss, but generated over $2 billion of cash flow. If this happens every year, I would be concerned. But this can happen once in a while, especially when a company passes through a large asset impairment. Let's look at a capital structure. $19 billion of equity, $8 billion of debt. They're 69% equity, 31% debt. And their WACC is 11.1%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $39 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $33 billion. We divide that by 2 billion shares. And we get a calculated stock price of $16. They're trading at $7.55, so they're trading at a 54% discount. It's a strong buy according to the model. Simply Wall Street is much higher than me. They're at $39 a share, so they're saying it's even more undervalued. It was hard to use a traditional discounted cash flow model to value this company because they had so many negatives. So I had to pull out some of the negatives that were just one-time items that weren't likely to occur in the future. I also looked at analyst estimates to project their future free cash flows. This stock was trading over $20 a share a few years back, but it's come down quite a bit. Especially when the market crashed in March last year, this stock took a real big dive. It came up a little bit. It's still trading at a major discount relative to its March high, an even bigger discount relative to its all-time high. In order to conserve cash, Cenovus cut its dividend last year. This company has a really high beta. It's almost 4, so the stock moves 4 times the market. The stock has gone down 34% in the past 52 weeks. The S&P 500 went up 14% in the same time frame. The low was $2 and the high was $12.45. The stock is trading above its 200-day moving average, but below its 50-day moving average. About 7 million shares are traded each day for this stock. And of the 2 billion shares outstanding, only 766 million are on float. 65% of the shares are held by institutions, and about 1.3% of the shares are shorted. If you invested $10,000 into this company 10 years ago, the value of your investment would be down to $2,100. That's a pretty bad return. The biggest shareholder is CK Hutchinson at 16%. Then the next shareholder owns 11.5%. Then ConocoPhillips 10%, then Capital Research, then Harris Associates. Let's look at the financial ratios. The average PE in the market's 11, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 0.9, so investors are paying 90 cents for $1 revenue. Price to book is stock price over book value per share. They're at 0.8. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 19 billion of equity, 17 billion of tangible equity, because they have 2.3 billion and 100 million of intangibles on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They have a good current ratio at 1.3. Their current assets are 200 million of cash, 1.5 billion of receivables, and 1.5 billion of inventory. So the company should have enough funding to get through the next 12 months without needing to take on more debt. They did have a small negative free cash flow. They do have a good amount of working capital on hand, and I do not believe their free cash flow will be negative in 2021. The best way to look at ratios to compare them to similar companies, I've done videos on BP, Husky, Imperial, Suncor, and Exxon, all in the same industry as Cenovus. And if Cenovus has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in PE, even though they're negative. Their negative is a little better than the average. They're worse in price to sales and price to book, even though they have a good ratio. They have a really good current ratio. They have a terrible ROE. They are higher than average in debt, but they're only 31%. And they're pretty close to the average market cap. I converted all these market caps to Canadian dollars. The average is 17.7 billion. And they don't pay a dividend. So to summarize, I do have them trading at a 54% discount because their stock price has come down so much. I ranked their free cash flow as 5 out of 10 because of that negative in the trailing 12 months. Their revenue I ranked 4 out of 10 since it dropped a lot in the trailing 12 months. I do expect it to increase in 2021 though. I ranked their ratio as 5 out of 10. They do have a good current ratio, and price to sales and price to book is okay, but they have negative PE and negative ROE. This is a pretty big company, 16 billion market cap, so I don't think it's going anywhere. The stock has taken a beating over the years. If you see the value of this industry and the value of this company, the stock price could be a steal. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.